Hey everybody, Coach D with TackleTrading.com here to talk to you about risk graphs, also known as P&L graphs. Risk graphs are a graphical representation that displays the range of profit or loss potential for an equity or an option position. The x-axis represents the price of the underlying security, and the y-axis represents the potential profit or loss of the position. Often called a P&L graph or a profit-loss diagram, this graph provides an easy way to understand and visualize the effects of what may happen to an equity or an option based on estimated or known variables. Risk graphs can be drawn to show the potential gains or losses for single options or securities, as well as for multiple leg strategies like spread trades or condors or any other combination strategy. Now, a risk graph has two primary components on the XY axis. Now, the x-axis is the price of the underlying asset. So here you can see I've got a scale that runs from $44 a share up to about $56 a share. Of course, you can show whatever scale you want. The y-axis will show you potential profits or losses. So imagine with me if we bought 100 shares of a stock at $50 per share. The break-even point, or $0, would be exactly at $50 per share. So that would be the break-even point. Now, if the stock price rose or fell, profits and losses would occur accordingly. So if I had that graph here that would show the stock position, if, for example, the stock dropped $1 times 100 shares down to 49, that would be a $100 drawdown. If it went down to 48, that would be a $200 drawdown. And conversely, if the stock price rose to 51, that would be a $100 profit. If it rose to 52, that'd be a $200 profit. If it rose to 53, that'd be a $300 profit. Now imagine with me, we have a risk graph for a call option that we buy at a $50 strike price for $3 per share. Now, each option contract is worth 100 shares on average. So what we would have is an expense of $3 per share times 100 shares. That would cost $300. So the risk on owning that option would be $300. You have the right to buy the stock at $50 per share. So that's going to show up on the graph. And that's the strike price. And if we paid $3 per share to have the right to buy it at 50, well, then our break-even point on the graph will come out at 53 at expiration. Now, this is just the rudimentary look at a long call risk graph, but we can easily see that the graph profits if we see the price of the asset rise. So if the underlying asset rises up above 53, 54, 55, by the time it gets out to 55, by expiration, we'd have a $200 profit because we have the right to buy it at 50. We spent $3 and we could turn around and sell it at 55. Hence, we would make $2 profit per share times 100 shares or $200. Now, if we were to look at this in a real life example inside of a trading platform, we can very quickly go in and see here what I've got is an example of the XLU, which is trading near $50 a share. And we have the right to buy the stock at 50. So here is a $50 call option that costs $3 per share. It's good till October. We have that $50 strike price. That's right where the graph bends. The break-even point's up here at 53. The maximum risk is $300. We have unlimited upside potential between now and the third Friday in October when those options expire. And the blue line here that you see here, the blue line right here, that represents the option at expiration. But we also have this pink line or this magenta line here that represents potential variables in time and volatility. So let me clean that up here real quick. And so, for example, we could estimate the time decay. Well, what if time passed? So I'm going to click on this little calendar down here. And, well, let me set this option actually out to when this expires in October. And then I can march this calendar forward, and every day that passes, that little blue-purple line moves, and you can see it dropping. Well, that's the time decay value being taken out of the option variable. Well, I can go set that back to today's price, and that line goes back. I could say, well, what if volatility shifted? What if the exploitation of volatility rose? Let's say it went up 3 or let's go 4%. You can see the magenta line pops up. Well, what if implied volatility went down 4%? You can see that in that drop. So you can account for all the variables in the risk graph, and it can do it for not just single options contracts or stock. It can do it for multiple contracts where you have spread trades, ratios, condors, anything you can buy or sell, a risk graph can plot. And it can help you understand your potential exposure to reward and risk and help you account for all of the variables in the financial markets, such as the price of the underlying asset, the amount of time until expiration, or the expectation of volatility changing. Now you've got a pretty good idea of how risk graphs work. And if you're interested in learning more and more about risk graphs, well, you need to come join us over at tackletrading.com, where we have an awesome immersion learning program that you can get into and learn for yourself how you can use risk graphs to help you make better trades.